Good afternoon, everyone. Can I please invite you to take your seat as we're about to start our policy panel discussion. Thank you.
Okay. Thank you, everyone. Please take your seat. We're going to start our very much anticipated policy panel for this afternoon. So our discussion for this conference takes place under the broad theme of a world in transition. And around us, we see shifting trade patterns, we see changing capital flows, we see new developments in the international monetary system, we see new technologies, we see intensifying geopolitical tensions. Each of these transitions is significant on its own. Their interaction is what makes the present moment especially complex and especially important for global stability, growth, and policy coordination. Now, to explore these issues, we have brought together 4 distinguished voices. Each will offer complementary perspective. We will begin with Hélène Rey, Lord Bagri Professor of Economics at London Business School, recipient of the Jo Jansen Award in 2013. And Hélène will start by setting the stage with a global perspective covering trade, capital flows, exchange rates, and the international monetary system, to name just a few. We will then turn to Kristin Forbes, Jerome and Dorothy Lemelson Professor of Management and Global Economics at MIT Sloan School of Management. And Kristin has been asked to bring in a more US-centered perspective, including on monetary policy in a world of heightened uncertainty. Then we'll move on to Philip Lane, Chief Economist and member of the Executive Board of the European Central Bank. We'll reflect on how the euro area views some of these global shifts and the challenges and opportunities for the euro in the international monetary system. And then we'll turn to Sethaput, who until very recently was the governor of the Bank of Thailand, and will provide the perspective from emerging markets angle, highlighting both vulnerabilities and opportunities in a world of transition. Now, throughout the conversation, we'll be hearing from each of the panelists. What are the main challenges confronting a world in transition? Are we ready? And how to adapt. Now, with that, let me invite Hélène to begin the discussion. Thank you.
Thank you very much, Pierre-Olivier. Thanks a lot to the organizers for having me here today to address this distinguished audience with my distinguished fellow panelists. It's really a pleasure. And I'm not going to be able, I can assure you, to talk about all the big themes that Pierre-Olivier just discussed a moment ago. However, I will try to set the stage for the discussion to address some of what I think are some of the most important policy issues at the moment. And the way I'm going to start is just by showing you this graph that is taken from the IMF External Sector Report of 2025, for which I was lucky enough to be one of the external consultants. And this graph, I like it very much because I think it's a very nice summary of the link between the importance of various countries and currencies in international trade and international financial networks. So what you have here is a measure of centrality. It's the eigenvalue centrality in trade network and financial network on the horizontal and vertical axis. And you have different points because it's over time. It's between 2011 and 2023. And what you see is that some countries are clearly above the 45-degree line, which means that they are more important, more central in the financial network than in the trade network. And you can see that these the positions are relatively persistent. However, we do see some action there. So if you take the United States, which is in blue, you see that the United States is very, very important in terms of centrality in the financial network, and it has increased over time, actually, and it has decreased a tiny bit in centrality in the trade network. The euro area has gone down a little bit in centrality in the financial network while remaining quite central. And you can contrast these two areas with China, which is on the other quadrant, where you can see that the centrality in the trade network is much more important than in the financial network, and that it has increased over time, especially in the trade network, quite substantially. Japan is quite balanced. It's on the 45-degree line, and the financial network centrality of the UK seems to have decreased quite a bit over time. So this is an interesting kind of snapshot over a number of years here, or where we are in terms of centrality in terms of various countries and currencies. But of course, the current situation is one in which there are very important shocks, very big shocks, that may reshape these networks, whether we think about the trade network or we think about the financial network. And here, I'm just going to draw, and I hope Jessie will forgive me for that. I think Jessie is there. On a paper that will be presented actually here at this conference, which is about looking at how firms internationally, so globally, have been responding to some of the big policy tools that have been used recently: tariffs, sanctions, and export controls. And what the paper does is that it uses LLMs in order to extract the reaction of firms in a more multidimensional way than some usual statistical analysis would enable us to do. So that's why it's very interesting. And what you can see is that there are firms in sender country and firms in receiver country. So what would be a sender country? It would be the United States, the sender country imposing tariffs on China, the receiver country. That's how you have to think about that. What you see is that from earning calls data, so these LLMs analysis enables the authors to show that firms respond quite differently to tariffs, so in blue, where you can see that, for example, in the sender country, you have quite a lot of firms who are going to be increasing their input, who see an increase in input price and a pass-through into sale price. So you see the two large bars, for example, blue bars there. But you also see that there's a number of adjustments that are going on, which are very interesting in terms of investment. For example, domestic investment going up, in particular when we look at export controls, and you see that especially in the receiver country, and also international investment, which might be about remodeling the supply chains, and R&D also going up. So there is a number of interesting reactions here that we can spot at the firm level, which means that there is some reshaping happening in terms of both innovation and also in terms of trade networks. And of course, if you look at the profit margins, then it's negative overall here, as you can see. Now, this reshaping of supply chain, maybe that we spotted in the investment reaction, is something that also some people at the fund, Gita and Pierre-Olivier and co-authors have been looking at. And indeed, we have seen some remodeling of supply chain through connectors countries, so that effectively maybe there is some fragmentation going on, but maybe not so much fragmentation. Maybe it's more like a rerouting of trade rather than an aggregate fragmentation of the trade flows that is happening in the world economy. Now, in parallel, or maybe in anticipation of, I don't know, there's a number of other actions that some countries have been taking in this environment. And for example, here I've been doing recently some work on the positioning of China in the networks of critical minerals markets. So it's not rare earths, but it's critical minerals for electrifications. And what I've been finding in this work, so across these 14 minerals that are very important for electrification, is that over time, and here you see on the left-hand side a network which is a 1995 network, and in 2022 on the right-hand side, the China node, which is in the middle here, has tremendously grown. And this is for lithium, but you can see that, and we can measure the centrality for all these other minerals. So what is happening is not only that China has positioned itself as a buyer, so as an importer, a main importer of these different minerals, but as a processor, and then as consumer and exporter of these minerals. So effectively has acquired a very central positions in these networks. So if I sum up some of these trends that I think we can see in the data based on these different types of these network analysis, is that we are seeing maybe something like a comeback of coercion, which was analyzed first by Albert Hirschman a while back, in the sense that the trade war and strategic positionings of different countries in trade, enabling coercion or maybe deterrence, are reshaping trade networks. So as I said before, it may not look like aggregate fragmentation, but it's more like a repositioning in global value chains that we are witnessing, which is an important, I think, new phenomenon. And this repositioning goes together, and we saw that a little bit from the firm data as well, but there's other papers documenting it, which are also quite interesting, but there's also a repositioning in terms of innovation. And there's this nice paper also by Flynn, Levy, and Moscona and Wu, who find that sectors with higher exposure to geopolitical risk exhibit significantly greater innovative activity. So this is something also that we discussed this morning with a paper of Luca about innovation and link with tariffs. So here there is another aspect, which is that maybe export restrictions and can be found to have some effect on innovation and the geography of innovation. So it seems that there is something very kind of fundamental maybe about this trend, which is that the strategic repositioning and this newfound innovation in different geographies seems to increase or to be there to increase sovereignty and resilience to geopolitical risk. Now, that's for what is happening, I think, in terms of reshaping of a geography of trade to some extent. Now, how does that play out in international finance? And here there's a lot more to say, so I'm just going to start. Maybe this creation of different trade corridors, different from the previous trade corridors, may increase currency competitions and the multipolarity of the financial system. So why would that be so? Well, if you had a lot of trade, let's say, between China and US, but now the trade is routed through Vietnam or Malaysia or Mexico and US, so there's more scope for different invoicing currency, different use of trade credit along that channel, that corridor, different bargaining positions of the various actors. On top of that, as we have seen, sanctions have been an impetus to increase the regionalization of payment systems, again, for sovereignty reasons, and that also is likely to increase multipolarity. Now, that doesn't necessarily mean that this leads to fragmentation, because the regionalization of the payment system or increase in currency of invoice in various regional trade blocs, they can still be linked. So we can have multipolarity and still important linkages. But we could also, and that's an important thing to keep in mind, have increased fragmentation due to this multipolarity. Now, there are lots of interesting issues that will be important for the shape of the future international monetary system, and I'm just going to scratch the surface here. But there are some interesting questions that I think some academic research still has not really tackled very much. For example, does the decline in transaction costs due to new technologies, due to cryptos, make the vehicle currency role of the US dollar less relevant? Indeed, are FIC market externality going to be as important as they were in the past in shaping the international role of the dollar, for example? Or is it the case that the ease of access to US dollar stablecoins, or maybe other instruments, will lead to greater dollarization in the world economy? And that's going to be also linked to the development of technologies and platforms in which maybe stablecoins and other assets can be traded with other things such as securities and maybe CBDCs. So how do we think about that? That's something that also we are only starting to try to formalize in academic research. So I will just conclude this introductory remark by saying that whatever the answer to these questions, which I don't think we really know right now, I think it is likely that international currency use and therefore the shape of a future international monetary system will not be left only to market forces in the current environment. Let me stop here.
Thank you, Hélène.
Thank you very much. It is a pleasure to be here. You could pop on my slides. Thank you. So I will confess, when I was first asked to speak on this panel and I saw the great list of papers, I was planning to talk about global imbalances and some new work I'm doing in that area. But then I got the marching orders from Pierre-Olivier and his team that I'm supposed to talk about the US. And I realized that we are dealing with a major imbalance on this panel. You have a surplus of people who work on global imbalances. And you have a deficit of Americans. So I will speak about the US economy, and hopefully we can get back to some of the global imbalances issues. So with that in mind, I'm going to talk about three issues, for three of the questions your team sent. First, why is the US economy so resilient? Second, what are some of the evolving risks behind that resilience? And then third, what are some of the implications for US imbalances? And then I can sneak in a little bit about what that means for the rest of the world at the end. Okay, so first, US resilience. We all know the US economy has held up quite well despite many warnings and discussion of doom and gloom, especially after some of the changes in policy last April. According to the definitive source on this, the IMF US growth has been upgraded this year and next year. So next year we'll have the fastest growth of any of the major advanced economies, again, according to the table. And this strong growth is not just a short-term thing about getting forecasts wrong this year. In the also, they upgraded the 5-year forecast for US growth, where if US growth is now upgraded for the next 5 years above what was being predicted in 2019. And think about that, 2019, that was before a pandemic. It was before a major war in Europe and war in the Middle East. It was before a spike in inflation, before interest rates went well above levels that anyone thought they would go to. And yet, US growth is stronger than people were predicting before all of that. So the US economy has been quite resilient. We have seen that also in the US stock market. Here's, for example, a broad stock market index of the US has outperformed that of the rest of the world. And this understates that outperformance because the world index includes the US index as a major share. But what explains this resilience? I think there's a number of factors, very quickly and very broadly. One is just the structure of the US economy is supportive of innovation. It has excellent universities that bring some of the brightest minds to this country, many of whom stay. It is a fairly deregulated environment, so it's easy to hire and fire workers, fairly flexible labor market, easy accessing to financing for all sorts of ideas. And there's a culture that supports innovation and taking risks. It's okay to try to start some companies and fail. That's okay. So all this comes together to support innovation and productivity growth. Then on top of that, there have been a number of changes over the last couple of years, or last year in particular, that has supported growth. Some in the US, it's deregulation, particularly in sectors where we're seeing a lot of innovation, supportive environment for AI, for crypto, for stable coins, and that is where a lot of innovation is and driving some of these stock market gains. We've also had tax cuts, and we've also had some deregulation in the financial sector, which is supporting this access to cheap finance, which in turn supports innovation. Then on top of that, we've had supportive monetary policy in the US. So there's some people who complain rates are still very high in the US, higher than averages over the last 20 years. The blue line shows nominal rates. They are still relatively high. But when you think about the cost of financing, it's the real rate that matters. So the red line is a super quick and dirty. You measure the real rate, just the nominal rate minus inflation. And you see real rates have been very low in the US, very supportive of access to financing. And even now, with interest rates in the US about 3.75, if inflation's about 3, that means the real rate's less than 1. I don't know where our start is or where neutral is, but that sounds pretty accommodative or at least not restrictive. So we've had pretty cheap access to financing in the US. And then, of course, there is support from the federal government. Here's the US fiscal balance, federal balance, bouncing around 6% of GDP right now, despite the fact we are not in a major recession or war or pandemic. So there's a lot of tailwinds supporting growth in the US economy, even though there are also some powerful headwinds, such as tariffs, uncertainty about trade, but the tailwinds are very strong. So I think that's the combination that supports US resilience. So what are the risks? We all know the risks of deregulating, especially in the financial sector, can often support a short-term sugar high, and then things do not end well. We've talked about that enough in these halls. I won't go on that. But instead, I want to talk a little bit more about the risks from monetary policy and fiscal policy. So monetary policy, what worries me is that I think we have become too complacent in the US about looking through shocks to inflation, where price level goes up a lot, inflation is too high, trusting the inflation anchor and that inflation will come back. So here's a graph from a project I did with Ihan Coase and John Grimha at the World Bank, where we look at trade-offs central banks have faced over time. Each of these bars is for a tightening cycle in the US, when central bank balances how do you bring down inflation versus not hurting output too much. And this measure is what we call the price-output trade-off ratio, where we look at the accumulated increase in the price level during a tightening cycle versus the accumulated output losses. So we basically look at two bads. How much do prices go up, and how much do you hurt the output and create an output gap? And you see different times you've chosen different balances for monetary policy. Sometimes you focus on stabilizing the labor market, let prices go up more, sometimes shift around the weights. Not saying one is right or wrong, but you see a real shift during the last tightening cycle in the US. Basically, all of the adjustment to some major shocks happened through prices. The price level went up about 15% more than it would have if inflation was at 2%, and there was almost no output gap. So basically, there's a choice made, accommodate the last set of shocks, let all the adjustment go through prices, price level went up, and then we'll bring inflation back to 2%, but don't take the pain in the labor market. So a lot of reasons for that we can talk about, but what worries me is that has now changed how people look at inflation and prices. Consumers are much more sensitive to prices. Firms adjust prices much quickly, and now we are getting a bunch of shocks through tariffs. So I think it's going to be much harder to keep inflation expectations anchored and bring inflation back down. Here's a little dramatic graph, but just a reminder about what can happen if you're too complacent. This shows inflation in the US. The purple line is today with 0 in 2020. And then the black line is starting in 1972. Yes, you can have a spike of inflation, it comes back down, but we're now 5 years in the US with inflation above our target. I think we can't continue to be complacent if we get another pickup in inflation from tariffs. Okay, so those are some of the risks from monetary policy. What about fiscal policy? I'm sure you've all seen this graph. It's the CBO forecast of US federal debt. Debt in the US has now passed 100% of GDP. We pay more in interest than we do in national defense. Could go on and on. All these statistics, if you live in this town, you probably know by heart. But what's worrisome is the way that line on the right goes up. Even if you're optimistic about growth in the US, it's hard to imagine that that is sustainable in any world. But I don't want to talk much more about that because I think we've all heard these concerns. We all know the issues. Instead, I want to shift to an angle of borrowing and financing that I don't think has gotten enough attention, and that is what is happening to the US external position. This is the US NIP position, net international investment position. This looks not just at the government, but it's the net borrowing or net financial exposure of households, companies, banks, and the government in the US. It's the net assets minus liabilities of the US versus the rest of the world. So it's basically the borrowing from the rest of the world. You'll see it sort of bounced around 25% of GDP roughly for a while, and it's deteriorated very sharply recently, especially since 2010. The slope of that line is even steeper than the slope of the federal debt line that we all spend a lot of time worrying about. So I think this is an issue that has not gotten enough attention. So how much should we be concerned? To understand that, we need to look at what's driving it. So here's a breakdown decomposing the US net international investment position from a new project I'm working on with Svetlana Nova and Stefan Andreev at the BIS. So the purple line here shows the US net international investment position. That's the graph I just showed you. Shows that sharp deterioration. So if you just decompose it, basic accounting, usually what often drives a lot of NIP positions is your trade balance or your current account balance, which is shown in blue here. And that was true for up till about 2000, where the deterioration in the US NIP position basically mirrored its trade deficit. And that sort of made sense. You're running a trade deficit that's funded by borrowing from abroad. The accumulation of that borrowing from abroad leads to your negative investment position, the purple line. But then you see this divergence around 2000. And this is really an amazing period where the US continued to run very large trade deficits, around 5–6% of GDP. So the blue line continued to go down. That it would have accumulated into a large net borrowing from abroad. But instead, the purple line stayed pretty flat. So somehow the US was running these big trade deficits, funded by borrowing from abroad, but it wasn't owing the rest of the world any more than it did the year before. And what explains that was largely the red line, which is valuation effects. We talked a little bit about this morning. Basically, US investors' investments abroad were earning higher returns than foreigners were earning in the US. So the fact that the US returns were so much higher basically wiped out a lot of that need for borrowing every year and helped pay for that trade deficit. I mean, there were some years US would run a trade deficit, $800 billion, and largely pay for that by earning higher returns on their overseas investments than foreigners were earning domestically. So pretty amazing period. But then where things have really evolved is since 2010, that has shifted. Since around then, US trade deficits have actually shrunk some and stabilized closer to 3% of GDP, but yet the NIP position has gotten a lot worse, and that is because these valuation effects has switched, where now the US is earning less on its foreign investments. Foreigners are earning a lot more from their investments in the US. So that is, we talk about the exorbitant privilege, it's defined different ways, but this suggests that this exorbitant privilege the US had in the 2000s could run these big trade deficits, basically funded by its investments abroad, that has now switched. It's gone the other direction. So what explains that? We actually talked about this a bit this morning. You can decompose what's changing the value, what's causing these valuation effects, what's driving the red line, into some different factors. In the interest of time, I'll just highlight two. We talked this morning about exchange rates. That's the bright green. Those do play some role in some years in particular. But the biggest change, the reason this privilege has shifted, is the yellow bars, where in the 2000s, 1990s and 2000s, the returns on US investments abroad were higher. That has now flipped, where foreigners are earning more from their investments in the US. So why has that flipped? A big part of it, not all of it, but part of it is foreigners own more US equities, and as the US equity market has done so well, which I showed you at the beginning, so a good share of those returns are being passed abroad and spent abroad and earned abroad. Okay, so finally, what's that mean for the rest of the world? I'll stick in one slide on that. So in terms of the rest of the world, this is very important because the US NIP position is a large share of global imbalances. So this is now, I'm taking NIP positions for countries around the world and scaling them by global GDP, just to get a sense of the relative size. You know, one line stands out there. You don't even have to look at the other countries. The US deficit now overwhelms deficits and surpluses in the rest of the world. And this also is a change. Back in roughly 2010, the size of the US net international deficit position was about 25 to 30% of global net asset and liability positions. Now it's closer to 75 to 80%. So what happens to the US NIP spillover effects around the world? Even if it's a small share of US GDP, it's a large share of global imbalances. And this is some good and bad news. First, let's start with the positives. So as the US equity market has done so well, and as the US has been so resilient, where I started, these positive returns in US equities have transmitted to the rest of the world because the rest of the world holds some exposure to US equities and FDI in the US. This shows the change in NIP positions for a bunch of countries around the world from just 2010 to 2024, so about 15 years. You see the NIP positions of a number of countries have improved quite dramatically. You know, Canada, Sweden, Korea, South Africa, then our NIP positions have improved by 50% of their GDP. Those are large gains, which are being filtered throughout the economy. And the big share of that is the dark green, which is returns on portfolio, increases in portfolio equity and FDI investment. So big gains to the rest of the world, and some of that is the resilience of the US economy. And of course, it's balanced by the negative at the top, which is the losses, relative decline in the US NIP. So the bottom line, to tie it together, US has been very resilient. That has been good news for the US. It has also been good news for the rest of the world in the sense that the positive returns in the US are filtering through into these global imbalances. But the bad news is these global imbalances have grown, and they have evolved in quite a striking way. So that now, if there is some sort of tremor in the US model, let's say the stock market does decline, let's say the AI increase in stock prices is a bubble that does not last, say there's a change in some of the US policies I talked about, which undermine equity investments and FDI investments in the US, then these solid gains we've seen around the rest of the world could also quickly dissipate. Thank you.
Thank you, Kristin.
So let me thank the organisers and Pierre-Olivier for the invitation to take part in this panel. So this is the 26th annual research conference of the IMF. Just before we started, I said, I think I was at the first one. And I went back and I did look. So I was a discussant at the first one, and I've contributed every so often over the years. And it's really been a great contribution to the global debate, and today's and tomorrow's program in particular is really good. Now, in forming these policy panels, the trick is to find a topic which really defeats the panel participants. And I think this phrasing here, our world in transition, are we ready to adapt? I don't think we're going to reach a final conclusion by the end of the panel. But my marching orders were indeed to bring a European perspective on it. And maybe again, contrasting the morning versus to what I'm about to do, this morning we heard quite a number of really interesting, intellectually consistent, coherent, disciplined models. Whereas speaking from a policy institution, I'm going to bounce around. So there's no internal consistency what I'm about to say, but it's more about to kind of stimulate and provoke the researchers here to think about some of these issues. Okay, and maybe the important thing to say, and again, at the ECB, when we think about the world, for quite a long time, we have said this decade, the 2020s, is a time of a lot of structural change. So whether that's demography, the green transition, digitalization, and the subvariant of AI and so on, it's clear some decades are more consequential than others. And this is also, when you overlay the pandemic on top of that, it's really been quite something. So let me emphasize that is, I think it's important to differentiate changes in the world economy that are happening anyway, big, huge forces behind it, versus policies. And then you can have the issue, what policies are endogenous, what policies are, and endogenous to what? But of course, you have to think about trade policy, industrial policy, FDI policy. And let me emphasize, it's also important to differentiate when thinking about these things between shocks or policy adjustments that in the end are local, i.e. you're moving the economy a little bit from where it was, versus, if you like, major adjustments. So a year ago, the ECB put out an occasional paper last December, which is basically about a fragmenting world economy, but they really meant it. It was really big drops in world trade, really big division between more or less an Eastern Bloc and a Western Bloc. We're not seeing that. So when we talk about, like this morning, tariff rates moving from 3 to 13 and so on, that's much more of a local adjustment. It's not leading to a kind of a sudden stop in the world economy. It's not leading to kind of zero access to inputs, well, at least assuming current policies are maintained. So I think that's also important. This is going back to the very wide question that the panel has taken on. There's a big difference between talking about that versus really major cleavages in the world economy. Okay, in any event, when I turn to Europe, I'm going to quickly race through some of the issues from the kind of global perspective relevant to Europe right now, and then I'll come back a little bit to the implications for the policy agenda. So here, what I show is different vintages of our projections. The IMF might be the world standard, the WEO, but we like our projections. So what I have here is what we thought the world would look like from the point of view of December 21. So we were coming out of the pandemic, but the Russian invasion of Ukraine had not happened. So in 2021, the blue line said we expected a pretty rapid bounce back in the European economy. And then what we have had is, if you look, basically there's nearly 2 years from early 22 to early 24 of flatlining. So that's very much a delayed recovery after the Russian-Ukraine war, the jump in energy prices, the high inflation, and so on. But since then, in the last couple of years, we have grown. And this is why we as the ECB have said, there's resilience in the European economy. That delayed recovery has been kicking in. But let me concentrate on the right panel, which is the same chart but for exports. You might say, well, all the way up to December 24 is the same flavor. Delayed recovery, but some recovery. But here I'm going to contrast the red line and the green line. What we believe in December 24 and what we put out in September, which is yet another hit to our export performance. So now we have, compared to what we expected, exports have grown. They are above the December 21 level, but much less than we expected. And you have to ask, okay, what is the mix between structural issues, spillovers from global policies, and of course, issues like the exchange rate? So let me talk about some structural issues. And again, how much of this shows up in volumes? I just showed you export volumes. And how much of this shows up in the terms of trade, I think is important. Because both margins are very relevant. And this is a graph that we use quite a bit, which is basically over these years, the Chinese and European economies have become to look more similar. So this is a similarity index. It doesn't look like this for the US, by the way. The US economy, in terms of sectors of exporting, sectors of production, remains quite different to the Chinese economy. In particular, the tech sector is very different. But you can think about this. If you essentially have Chinese firms and European firms competing in the same sectors, that's going to have implications for production in Europe, but also for the terms of trade. The ability of European firms to charge prices around the world is obviously different with greater competition. There's nothing to say the old level of competition was perfect. This is a structural change. If China becomes more productive, enters higher tech sectors, this is something you have to adapt to. So the adaptation in the policy panel title is relevant. The right panel with small type is basically saying this is fairly widespread. It's in a lot of sectors. Let me make a second point, which is a global point. This is not about Europe in particular. It's about the changing nature of the Chinese economy. And again, to repeat, as countries get more advanced, there will be changes, even before you start thinking about policy choices. But from a macro point of view, this is kind of relevant. Between the year 2000 and 2020, is pretty easy to put into our forecasting model. The import elasticity of Chinese growth is 1. If they grow by 10%, imports go by 10%. It's now 0.5. In 5 years, that's a pretty big change in the relationship between Chinese GDP and Chinese imports. That in terms of structural change, is quite something. Again, I'm not making any welfare judgment there, but it's something to observe and to think about. And you might say, well, okay, you now have more competition from China. You also have this more limited access to the Chinese economy as an export destination. What's happening to the exchange rate? And here, there's some interesting features. And of course, we all like to think about the euro-dollar rate. That in the left panel, that's the red line. And what you see here is there was a big depreciation of the euro in late 2014, early 2015, when the ECB embraced QE. But since then, until quite recently, it's bounced around. It's been incredibly stable around 110. No big trend in that rate. This year, it's moved. So there was a depreciation late last year. So compared to the bottom a year ago, it's appreciated more. But let me emphasize maybe the bigger story here is a much bigger appreciation against the rest of the world. And then you might say, well, what is this rest of the world? Where is that appreciation? A lot of it is vis-a-vis Asian currencies. And that's the middle panel. Yes, that's China, but it's also Japan, it's also Korea. So there's a big set of issues there about the changing structure of the world economy, and then whether exchange rates are absorbing that or amplifying those issues. I look in the room and I see some people who've worked on Asian real exchange rates, the unusual nature of Chinese exchange rate developments and so on, but I think it's relevant. Okay, let me jump now, and this is where internal coherence says, okay, I'm not trying to link the exchange rate topic now to the current account topic, but let me say in the end, I think what Kristin did was interesting there, but I'm not doing net IIP, I'm just doing the current account. But I think there's a couple of messages from this graph. One, so the solid blue line is our estimate, which is a little bit different from the IMF estimate of the equilibrium current account for the euro area. And again, remember, that's kind of a 5-year average, type current account. But maybe importantly, it's drifting up. So you might have thought, well, euro area, apart from that first decade of the euro when the periphery ran big deficits offsetting the German surplus, has been a surplus, chronic surplus type region. But in terms of these fundamental drivers, it's moving up. And a lot of it connects to what Kristin just said, which is the relative growth rate of Europe is drifting down. So if the big growth opportunities are with American firms, the rational investment response is to run a current account surplus. So that light blue box is called the economic outlook, but it's basically relative productivity growth. And that is something which is not exactly, I'll come to the endogeneity of that in a minute. There's also demography. Everyone's aging, I'm aging, Europe is aging, but Europe is aging quite beyond the global average, so that is also there. The other point, the dotted line is the actual current account. So on top of this slow-moving element, there is a cyclical element. And maybe going back to the uncertainty and the risk that Kristin said, it is actually, if you stop the clock in 2019, you might say, why is Europe running not only the so-called equilibrium amount, but this extra amount? So going to a 3% of GDP surplus. For a continental-sized economy, that's a lot. But then when the energy price shock happened, Europe paid for that by running down the current account surplus to zero, more or less zero. So when people say, well, and the lesson now for many people is precautionary savings is a good idea. The world of uncertainty means many households, many corporates are concluding, let's have a buffer. And if that is more powerful in Europe than it is, say, in America, that precautionary principle, then that leads to imbalances. Okay, let me say the other conclusion from all of that is essentially, let's have a stronger growth rate in Europe. And the extra element here I'm going to say is, of course, Draghi letter, lots of people know the list of policy measures. When quite a lot of countries are far from the frontier, it's not that hard to grow more quickly. It's not pushing the frontier outwards. It's just adopting better policies and so on. But let me say there is a spillover to the whole capital market agenda. As Kristin said, to facilitate growth, you need financing. And to move ahead with capital markets union, banking union, it's hand in hand. So there's a complementarity between the growth agenda and the financial agenda in Europe. But let me stop there.
Thank you, Philip.
First, let me thank the organizers for having me. It's a great pleasure and a privilege to be on such a distinguished panel and to share the perspective of emerging markets. So let me start off by echoing an observation made by many people, including the fund, that emerging markets have proven themselves quite resilient thus far. And this has been different from previous episodes where you experienced monetary tightening from advanced economies, where it triggered these episodes of turmoil in emerging markets. But this time around, things have looked, fairly orderly. And the chapter 2 of the WEO raised the question of whether this was due to good luck in terms of a benign policy, benign environment, or due to good policy. And as a former emerging market policymaker, I have a completely unbiased view on this, that it was a large chunk of this was due to good policy. It's stuff that I think people have noted, this better monetary policy frameworks, use of inflation targeting, more flexible exchange rates, improved currency mismatches and whatnot. So I won't go through that. But what I would like to do is make 2 points about this resilience. This first is that this kind of good resilience in the aggregate masks a lot of heterogeneity. First off, the same kind of shock that we see has very different qualitative results on different emerging markets. So an example, we've seen the dollar depreciation, which for some countries has been quite good. It's been led to an easing of the financial conditions, but in certain countries, like Thailand, for example, that's led to a local appreciation of the baht, and that tends to, in Thailand, tighten financial conditions. And you obviously have different countries that are vulnerable to different kinds of shocks. Certain countries are much more vulnerable and less resilient to financial shocks, others much more so to commodity price shocks. But by and large, emerging markets, by their nature, because they're small open economies, are very, very vulnerable to trade shocks. And one thing that we see, I think, to give you an example of how that resilience is under threat, is just to take one example, how U.S. trade negotiators will define transshipment, and the implication, the impact of that will have on many economies, whether it's a Mexico or a Vietnam or a Malaysia that are plugged into the global value chains, shows you, how vulnerable these countries are to those kinds of shocks. Which leads me to the second point about the resilience, which is that aside from being fairly heterogeneous, most emerging markets, while they, I think, have tended to be more resilient to financial shocks, they are still very exposed and much more vulnerable to real shocks. And the kind of, most of the studies that have been done, that have been writing about the resilience of emerging markets have done mostly in the context of these financial shocks, your typical kind of risk-off episodes, right? And I don't doubt that we are more resilient to that kind of shock. And that's partly because the playbook on that has been fairly well established. We know what to do, right? We've done a good job in terms of building and strengthening those policy frameworks I mentioned and rebuilding buffers and whatnot. But how do you make yourself more resilient to a real shock, like a net secular loss of final demand, which is what we're seeing now? And where is the long-term trend growth that we need to see, improvement in the long-term trend growth that we need to see in emerging markets? Where is that going to come from in this environment where you have this threats to the final demand that we face? If you look at the WEO forecasts, again, the output forecasts look okay, but the forecasts for trade don't look so great, and particularly the forecasts for export growth of emerging markets don't look so great. And it's not just export growth that's suffering, but we're also being affected by greater import competition. If you look, for example, at in the September numbers, Chinese exports to the U.S. Dropped by 27%, but Chinese exports to the whole world increased by 8%. And to ASEAN countries, for example, they grew by 16%. So, a lot of emerging markets are facing much, much greater import competition as well. And it's something, again, that emerging markets are very, very exposed to because by nature we are small, open economies, we have small markets, and we are far from the technological frontier. So we still, and because trade and technology, know-how, FDI, all that stuff comes kind of together, we're very exposed to that kind of shock. And so, yeah, we can think of how we might diversify our export markets, maybe export to other emerging markets and whatnot, but where is the technology going to come from, right? Because we're quite far from the frontier. And that access to trade, technology, investment is so important, right? And if you look at the IMF, when they came up with their typology for classifying economies as to advanced economies in 1997, we see that of the 13 economies that have managed to graduate to advanced economy status, all but 2 were from Europe. So that shows, again, the importance of access to markets and know-how. And the challenge that comes with this slower growth is where are the opportunities for the new generation going to come from, right? When the pie is not growing that rapidly, people naturally, right, focus a lot more on the distribution. And we see, again, around the world, the Gen Z protests that have been occurring in a variety of different countries. And the thing that I think tends to characterize them, it's this commonalities that we see. These are countries are often youth unemployment is quite high, inequality is high, and there are gaps in governance. And so, yeah, and again, if inequality is high, and things don't look good, maybe that's okay if people have hope and for the opportunity for things to be better. But again, when you have a situation where the youth unemployment is high and the opportunities aren't being created, that creates that kind of tension. And I'm reminded of what Al Hirschman also said about comparing development to a 2-lane traffic jam, which is when you're both stuck in traffic like this, and initially one lane starts to move. Your initial reaction is to think that this is good because you think you're going to be moving soon, so it's good news. But if over time, right, you're stuck in that lane and the other lane keeps on moving, then that movement in the other lane is no longer a source of joy, but it's a source of resentment. And again, people will move and you get gridlock and whatnot. I'm extending the analogy there. I apologize to Al Hirschman. So what to do? Let me start off by saying what not to do, because there's a lot of things that I think that we're doing right now which are taking us in the wrong direction. We're using up too much policy space, I think, to try to shore up short-term growth. We're not doing enough stuff on the structural front, and that's risky. That's risky because it undermines, again, I think, our long-term resilience. I think there's a lot of empirical evidence out there that when you get these big shocks and you're not able to try to stabilize things, they're the hysteresis effects or path-dependent effects, that those big shocks undermine your long-term growth. And we've seen that in the Thai context very, very clearly. Back in the heyday, in our glory days before the Asian financial crisis, we were going at a very rapid clip. After the 1997 crisis, that we bounced back, but we bounced back, but in a weaker state. So we went after 1997, bounced back, growth dropped down to 5%, got hit with the 2008 financial crisis, bounced back, but growth then dropped to 3-something%. And since COVID, bounced back, but again, growth dropped down to 2-something%. So it's again a sign that again these shocks are not helping with our long-term resilience, especially if we're not able to engage in appropriate stabilization policy. And by using up so much of our policy space in the near term, I worry that we're exposing ourselves to that risk. And we're also not using tools properly. We're using the wrong kind of tools. A lot of countries are facing constraints on the fiscal side, so attention then shifts to the monetary side. And there's pressure, again, to try to do more on the monetary policy front. And I understand where this pressure has come from, right? Because people feel, things are not good. You should do something. Don't just stand there, do something. But if that something is not the right thing to do, or if you do it and it's not effective, then that carries risks. And my concern, again, is that there's this gap between what people expect monetary policy to be able to deliver, which again will lead, again, I think, to disappointment, and people feel that then that monetary policy is under-delivered. That leads to issues with credibility, and when that comes along, it starts to undermine the support that people have for things like, good things like central bank independence. So what things to do? I won't go through, this is the usual laundry list of stuff, right, that the World Bank and the IMF puts out, of good things to do to try to improve investment and productivity and whatnot, and a long usual list, and none of it ever gets done because it's never incentive compatible, so I won't go through that. But there's stuff, again, that countries on their own obviously can choose to do or not do, as the case may be. So, but here, given this environment where we are here in this multilateral organization, let me focus on stuff that we can do kind of a bit more collectively. So I think one thing that's important to do is obviously greater collaboration among emerging markets. And I think part of that requires us for emerging markets and emerging market policymakers to appreciate the greater sense of agency that we have, right? And there are these numbers out there that about how emerging markets account for X% share of global growth and whatnot. And I think that's important to keep in mind because there's this unfortunate, I think, this kind of mental image or even caricature of emerging markets, like, where this stuff happens in advanced economies and we passively accept these shocks, which is I think counterproductive because again, it's not accurate for one, because I think now the source of a lot of the shocks is not just coming from the advanced economies, but also coming from certain large emerging markets. But it's also not constructive from an agency standpoint, so I think it's important for us to be able to focus on the things that we can do. But I think organizations like the IMF here have an important role to try to facilitate that agency and try to adapt, because I think the kind of collaboration that we saw in the multilateral settings, I think is not likely to be that productive going forward. We need to move to a different kind of collaboration. And I think other authors have commented on this, but the way I think of it is we need to move to what I would call more practical or more pragmatic pluralism. So you work with the people that are ready and willing to work together. And that might mean, again, that the existing groupings, which are often regional in nature, are not the most appropriate groupings for that. Because those groupings tend, I think, not to be fit for purpose for the kinds of things that we're seeing. So what do I mean by that? Let me give you a concrete example. In the payment space in ASEAN. So Thailand and Singapore, we did the first bilateral fast payment system linkage between the two countries, and it worked quite well. So instead of trying to do a bunch of all these different bilateral linkages, it would be a big headache, we decided to try to work together to do a multilateral linkage. So we got together with other ASEAN countries that were ready and willing to do so. Initially there were 5, now it's down to 4. But then, India was interested in joining the project, so they brought in. So not an ASEAN member, and we didn't bring all the ASEAN members along because, again, the readiness and the willingness was not there. But again, example of a project, and this project is called Nexus, which I think is an example of if you get people that are ready and willing to come together to put together this payment system, which we expect to go live in 2026. And if it works, it will help make us that much more efficient, that much more integrated, and just that little bit more resilient. So let me stop there. Thank you very much.
Okay, well, we had 4 very different, very complementary opening remarks. I will not try to summarize them all, but before I turn back to the speakers, let me flag a few points that I thought were relevant in what I heard. First, I think Philip's point that we should think differently about local and global change. I think that's absolutely important. And of course, part of the difficulty for policymakers or for us here at the fund is to identify whether something that just starts changing, which is still local, is going to be something that develops into a new trend and something that we want to address early on, or whether that's going to be something that will resorb itself naturally. Now, we're paid to worry, so here at the fund, at least, we tend to see a lot of things that move up as worrying them about them moving up too much or coming down and moving down too much. But I think that's kind of the right framework. And here in that space, I think Hélène emphasized the fact that international relations are changing. We are seeing increasing use of sanctions or trade policies in a way that is designed to change the structure of industries or change international trade. And the way I think about it, there are two effects. One is, at some level, if we are dependent, if there is a level of dependency that is very acute, then of course you want to reduce that. You want to improve the resilience. But of course, the risk is that doing that may make you more resilient, but at the same time, the other countries want to do the same thing. They might be dependent on some other thing from you. They want to also become more resilient. The outcome of that process may be deglobalization by default. And if you're in a deglobalization by default, you get all of the cost of deglobalization, but you also get the fact that it's also easier to maybe try to engage in some forms of coercion because you don't suffer tit for tat. Being more resilient means that you don't have to suffer some of the consequence. So I kind of worry that we are losing maybe some aspects of mutual deterrence when we are very interlinked. And to some extent, what we're seeing right now in the global economy is an economy that has remained very interlinked and where there are these mutual dependencies that are putting a cap on how far we can go because there are multiple ways of retaliation. If we become more independent, maybe it becomes more volatile. The second observation is, and that goes back to, I think, a point that Sethaput was making, which is for small open economies, a loss of access to market for their products, which is on the real side, can be very devastating. At the same time, when you look at the global economy, and if we think about when we had big crises, they always had financial components. Sort of the real side can slow down your economy. Maybe you can get a global recession. But really big things that happen, like the global financial crisis, they have a very strong financial component. As long as finance kind of is holding up, the real side can be bad, but it cannot be that bad on its own. Now, I think there's a difference between the small economies and the large economies in there, or the global economy. But I think that's an interesting observation. And finance has been holding up. I mean, as Kristin was pointing out, as others have shown, the capital flows have been continuing to be very, very unaffected by everything else that was going on, even when we're looking at the demand for government bonds or equities. We've seen the flows remaining very strong. So the question is how much of a risk that is. The third observation I would want to make is I already pointed out the fact that you're trying to improve resilience. It might be bad at the global level. It might be self-defeating. It might be bad also in terms of your own domestic economy. There is a risk of duplication. There is a risk of reinventing the wheel. There is a risk of going into industrial policies. And I think that is something that we're hearing from a lot of countries, that the de-risking story can be commingled with almost like an import substitution story. And we know that this is something that is a risk for the global economy. Next observation I would want to make is a lot of the things that are behind this is we're coming out of a sequence of shocks that have strained public finance in many parts of the world. Almost all the parts of the world, fiscal space has been eroded. And now we're also seeing governments trying to grapple with that. And that's something that I think Kristin mentioned, but I want to come back to and give the panelists an opportunity to think about. What we're seeing in some countries is the temptation. I think the Mundell Fleming lecture, if I can put a plug for this tomorrow, will elaborate on this, is in a world in which you don't have that much fiscal space, you're going to start becoming very creative. And you're going to start doing things that you wouldn't do in normal times, whether that's going to be putting pressure on other institutions, whether it's central banks or other things, moving into financial repression. And I'm kind of wondering, and here I'm kind of musing out aloud, whether in some sense, some forms of trade policy that we've seen are also not an example of what I would call fiscal dominance of trade policy. That when all is said and done, maybe the tax revenue, the tariff revenues are the things that are going to be very hard to undo once it's there. And that's going to maybe shape fiscal policy and decision making for some time to come. And so given all of this, I think the last point that Sethaput made was also very important, which is what is the role of multilateral organizations? What is the space for a multilateralism more broadly defined. I mean, at the fund, we've been talking about a pragmatic multilateralism for some time now, which is sort of this idea that you try to make progress where you can, and maybe there are some areas where you bide your time and some areas where you realize you won't be able to make headway. But there is different geometry there. It could be at the level of a group of countries. I think that's what Sethaput was mentioning. Or it could be at the level of certain topics where you want to make progress, whether it's something like debt resolution, the GFSN, or more resilience, or a framework for stable coins or digital currencies. I think there are areas that are common goods where you can see countries sort of seeing their interests aligned and trying to make progress. And I think identifying those and focusing efforts on these is maybe a very promising way of moving forward. So with this, let me stop here and maybe end with one final point, which is Philip, on your slides about China and the increased competition and similarity index, I think is really fascinating. And I think from that perspective, one of the things that when we're looking at this from here, we are, I'd be curious about your views about what is the best response function for the Europeans in the face of an increased redirection of trade that's coming maybe from China, and not just from China, actually, China and other Asian countries, because that's where we see some of the rerouting of trade coming on. I think that's what we certainly see that as an important risk going forward. With this, maybe, and please feel free to also respond to each other. Let me, who wants to start? Maybe in the order we started, or Philip, you want to start?
Well, since you asked me a direct question, which I think is an interesting question about the best response function. And actually, the Draghi report, I think was quite, snappy about this, which is basically, you have to look at the list of sectors. In some sectors, you basically say, let's welcome it. If there's going to be a super cheap, more efficient import, sometimes you just say, fantastic. In other sectors, you do have to think about, and a bit like Luca this morning, in other sectors, you have to think about what is the long-term consequence. Do we really want to have the erosion of the production capabilities in Europe in this sector? And Luca's framing this morning, I mean, these are the relevant issues: externalities, local externalities, all of this. Then the resilience issue and so on. So, again, the Draghi report has a lot of it, but that basic split between where do you want to say that's just a change in comparative advantage. You should embrace it. It releases resources in Europe to work on something else. And where do you want to be selective about that? And let me mention, I mean, Europe has a pretty elaborate policy set up for this. There is a whole anti-coercion instrument, basically working out, okay, here's, in a WTO compliant way, here's how you can, in a calibrated way, respond essentially to if you see a surge in imports that really you think is more coming from a domestic policy distortion elsewhere, not just some machine in terms of driving comparative advantage. So I think the answer is going to be variable, but the ideally, of course, is both the European institutions, but of course the IMF can join in, is having cold, headed analytical distinctions. Because what you said about, respectable arguments like resilience being a cover for pure protectionism is a risk. So the more we can use a kind of the analytics of what are core sectors, what are sectors where you do want to have a significant domestic production capacity, I think is relevant. Let me also just advertise from an EU point of view, this basically, what is the EU and what is the EU area? It's pragmatic multilateralism at a regional level. Imagine how all the member countries of Europe would be dealing with these global shocks if they were all on their own navigating individual policy responses. So I would say, and even going to what I just ended on, people say, oh, the Draghi report, where's the I mean, there's a lot of things going on, but I think the relevant benchmark is, without the European Union, would the overall growth rate of Europe be higher or lower? I'm pretty sure a lot lower. And as you mentioned, a lot of European countries have moved up over these decades. So that's not complacency, lots not to be complacent about, but there's a lot to be said for regional multilateralism.
Thank you, Philip. Hélène, and then Kristin.
Yes, so I wanted to react on your point on increase of resiliency, which might lead to deglobalization, which I think is a very interesting thing to discuss. So I wanted to point it out that I think what we are seeing is this increase in resiliency applies a lot to a regional level. And Sethaput was discussing about how he feels an increased cooperation among emerging markets. And I think actually in European countries, what you are seeing is also that there is a need and a desire to integrate further from an economic point of view and to strengthen the cooperation among the region. So I would say maybe more than deglobalization, I think there is a drive towards regionalization. And one thing I think that for example, the IMF would be instrumental in is if we take an example that Sethaput also took, which is the payment systems. So for a resiliency point of view, for a sovereignty point of view, there is this increased regionalization of payment systems, which are being driven in various ways with different technologies in different areas. But one can understand because one wants to have one's own data, one wants not to be dependent on various international infrastructures, et cetera, but then one still needs to think about the interconnections, the interoperability of these various payment systems at some level. And certainly the multilateralism there should not be absent of this debate. I mean, one has to make sure that at some level there are some connections, and so some norms, some standards, some regulations that will go through all these regionalizations. So that's a very, very strong role for multilateral organizations still.
Kristin?
Two comments. One, just a quick reaction to Philip, and then a broader one for all of you. I thought your comment was quite interesting, how Europe follows the precautionary principle. You see it in the current account balances going to surplus, higher savings than investment. And it just struck me what a difference with the US economy, where I'm not sure what the term is, the risk-loving principle, where we have the large current account deficits, we have the large fiscal deficits, large debt positions, federal government, as well as NIP. But the flip side of that is also it is this risk-loving in the US, which is why people take risks and innovate, and why we've had some of these great innovations and productivity growth. So I'm not sure where the balance is in there. It's probably somewhere in between our two extremes. But then here's the broader comment to all of you. So Pierre-Olivier, you mentioned that you were increasingly worried that as fiscal space gets constrained, you get creative, and tariffs may be part of the solution to that. I share your concerns that I think now the fiscal revenue from tariffs is big enough, even if we did have a change of thinking, change of regime, so the US wanted to backtrack on tariffs, it's become a big part of the revenues. The CBO, I mean, it's hard to estimate what the revenues are because we're not sure where the tariffs will be in a year from now. But the CBO's latest estimates are roughly, if you look at US debt over the next 10 years, basically 20% of the debt increase is going to be paid for by tariff revenue. That's a big number. I don't know if that's right or not. There's a lot of assumptions, but the fiscal sort of savings from tariffs could be meaningful enough. It's just going to be hard to get rid of them without some other changes that are even more costly. But I think it's also more than that, why these change in tariffs are going to stay. It's not just about revenue. It's also, there has been a real change in Washington, in the US, where there's just not support for free trade. I find it striking, Democrats and Republicans can't agree on much, but they seem to largely agree on that globalization has not worked out well. And you see this sort of develop over the years. So we are in a new regime. We've been in a regime where we had a multilateral rules-based trading system. I don't think we're going back there, at least in the US. Whether you like it or not, we are now in a new world where it's a power-based system. It's more unilateral, it's more based on mercantilism, and it's more based on accomplishing specific goals. So there where the regional arrangements that Sethaput talked about, I think are going to be more and more powerful, where it is about sort of who has more power in negotiations on a whole set of issues, not just trade, a whole set of issues, ways to form coalitions, even in specific areas, specific topics will be important to add some balance back to this new system, because we're not going back where we were. But then the final point on this was back to so you get creative when you don't have fiscal space. I think a great example of that is the new US regulations on stablecoins. So US has a large debt. I think there could be issues financing that debt going forward, especially as more and more the debt is financed short term. The US always financed its debt much shorter term than major economies, but it's even shifting more and more to a larger share of that debt in T-bills, so to be rolled over every year. That creates tremendous risks. It's just a short-term shock to financing, could have much bigger implications. So how do you get around that? Create regulations for stablecoins, where stablecoins have to be backed by these short-term T-bills, and you create demand to help stabilize demand for this debt. So then that leads to my question to all of you. What are each of you thinking? If this now means increased stablecoins backed by US T-bills, what are the risks for the rest of the world?
Sethaput, maybe on this and other things.
Yeah, before Kristin's question is an excellent one. I think a lot of ones we're grappling with. I want to get to what you said first about whether increasing resiliency would lead to less globalization. I think it's important for us to try to channel it so that it goes the right way. And so if we talk about globalization, right? But if we think about countries that when they trade and whatnot, we don't trade with the whole globe. It's usually just, yeah, I mean, it's fairly concentrated people that we interact with, we deal with, we trade with. So I think that gives a little hope that, that we can go that more, again, whatever you call it, the practical or pragmatic pluralism, that you deepen the integration where you can and whatnot, and avoid making resiliency become like import substitution, like you mentioned, because that I think would be the kiss of death. But I think to try to expect that you get the globalization, kind of the broad multilateralism like we used to have before, I think those days are gone. Actually, you raised something that I'd be interested in what the panel also thinks, which was, so long as the financial side holds up, even if you get real shocks, you don't get a crisis. That's I don't know what people think about that. That's a fairly strong statement. Maybe you don't get
trying to be provocative.
Yeah. I mean, I can see that you don't get a financial crisis, right? Just by definition, because the financial side holds up. But again, if these real shocks end up creating all this social turmoil, you get a different kind of crisis. I don't know what you mean. It's not again maybe an economic financial crisis, but a sustained series of protests and whatnot makes it very difficult for you to kind of engage in any long-term kind of policy type stuff. I think again maybe you wouldn't call it a financial crisis, but it is certainly not healthy. To respond to Kristin's point, if I had to look back and like kind of the things that gave me a big headache when I was in my previous job as governor of the central bank, it wasn't necessarily all the monetary policy stuff that we usually get criticized for, but there was, for example, issues when it hit people at the grassroots level. So issues related to fraud, extremely damaging. And one concern that we have when we trace this whole kind of fraud business, the role that stablecoins and crypto have. I mean, on us we regulate the banking side. So in terms of dealing with all the mule accounts and the bank system, we were able to kind of do a good job there. But we saw when we clamped down on the banking sector, then there tended to be movements out through digital assets and through crypto and whatnot, because the KYC type things don't work as well in that space as they do with the banking sector. So to the extent that gets facilitated, I worry, aside from the whole kind of, whether economies like us would get dollarized or whatnot, I don't worry about that so much, but I do worry about the AML, CFT fraud type stuff coming from that.
Can I respond to Kristin on the stable?
And then just want to say, we'll move on to questions from the floor. So if you can please line up behind the microphones, and then we'll collect a few questions for the panelists. So while we're hearing from Phil, please stand up by the mic.
There's a big difference between a store of value desire versus a medium of exchange desire. Stable coins don't look exactly like the best store of value mechanism. And from what you showed and what came up this morning, of course, US equities has been what you want to hold. So if you say, well, here's a zero interest stablecoin, here's a US equity fund. If your goal is to kind of have a safe haven asset, I think I'm going to go for the equity fund. So that's not to rule out in terms of the fact that there may well be a role for dollar stable coins in global payments and so on. And there will be, of course, some parts of the world economy, but in line with what you said, a lot of the emerging markets are far more resilient in terms of the financial system. So again, the pros and cons of holding domestic currency assets versus foreign currency, it's different to before. So it's going to be super interesting to see this question. But I would, more focus on the US, all the financial assets the US holds, rather than stable coins.
Okay. So if I can just add also Hélène, to that question. So I think one first order of concern indeed has to be with the use of stable coins as a ramp on and off the crypto ecosystem in a world in which already the crypto ecosystem and stable coins in particular are used to evade regulation, to evade taxation, to do transactions that would otherwise not be allowed. And I think an increase in stablecoin use would just facilitate enormously this type of illegal transactions, if not properly regulated, in a world in which public finances are already very much under attack. So that is a very serious issue, and for me that is maybe the number one issue. Then there's the issue, obviously, of financial stability and the fact that stablecoins may be exposed to run, just like money market funds, in absence of a lender of last resort. And that brings us back to a world of private money, in which money, is not worth the same thing, depending on who issues it. And that can lead also to fragmentation and to potentially destabilizing dynamics. So this is also a very important issue. And finally, I would say, in all these discussions, we often overlook simply the technological issues and in that case, the cryptology issues, and the fact that some of these encryption technologies may be unequally sound and unequally resilient to future developments in quantum computing, for example, which will add a layer of complexity to the problems if everybody is using different stablecoins where you don't exactly know which one is the safest one. And that could lead to potentially pretty destabilizing dynamics. So that's what I would put in the series of worries here, of risks.
Okay, so I think we're going to start with the question from the young lady at the back, and then we'll go to Ricardo.
Yes, sure. This is Luisa Balen. I work in the debt policy division, and thank you for the wonderful insights and discussions. I've been holding this question for a while, and hopefully it's a good one. This question is for Kristin. Why aren't we worried more about the persistent increase in public debt in the United States? And is it only a fiscal concern for low-income and emerging economies? Thank you so much.
We'll collect a few, so Ricardo and then John Maria.
Thank you. Ricardo Reis, London School of Economics. This is a question for Sethaput. Your country has, I believe, roughly 50% of foreign exchange reserves, or has a large number of foreign exchange reserves. I thought it was 50%, but now I'm trembling with your... But generally in Asia, there's a lot of foreign exchange reserves being held. If I think about the world with the trade fragmentation that, say, Pierre-Olivier described, the change in international currency that Hélène described, and the potential for what's going on in fiscal policy instability of the US economy, how do we think that going ahead, when things about both the size of foreign exchange reserves as well as the composition across different currencies? That's a question that seems very unexplored in this new world. How would a country like Thailand or those around them think about their foreign exchange imbalances in that context? Thank you.
John Maria.
Maybe for the non-institutional speakers on the panel, central bank independence and threats to the independence of the Fed. Is your sense that markets are right in their apparent complacency about the risks of a watering down of the Federal Reserve's ability to conduct an independent monetary policy? Or what is your rationale for what is happening at the moment when we still see buoyancy despite very clear indications of an attempt by the political system to gain leverage on the central bank? Thank you.
So maybe Kristin, we start with you. There was a question on fiscal policy. Feel free to address any of the others on reserves or central bank independence.
I think if I understood your question correctly, it's why should we worry about U.S. debt and deficits? I mean, I think right now, some debt is fine, some deficits are fine, but now the levels are so high. When we're paying, what is it now, 20% of interest, 20% of GDP on just interest payments, a lot of which goes abroad. It's leaving the U.S. And I worry about also the ability to keep financing. As the debt has grown, rolling it over is going to be a big amount of financing that has to be absorbed, and now on very short term. So it just takes some confidence shock, some change of policy. You're not going to roll it over. Borrowing costs spike, and then that will have spillovers for the rest of the world. When U.S. rates spike, it spills over. Even though people are more resilient, as their countries are more resilient, as Sethaput said, there are still costs.
I don't think we really worry. I don't know. I get that sense, but
I mean, I worry. I do think the stable coin, the way that has moved short term and the way to link stable coin to financing that will buy it a little more time, but the concerns will not go away. No, I worry very much. Then the issue is central bank independence. You know, I am still surprised we haven't seen more market reaction. If you'd asked me this 6 months ago, I would have said nothing to worry about. Of course, the Fed is independent, is strong support in that. If there's any threats to that, you will see a market reaction, and then the threats will step back. That has changed over the last 6 months, obviously. So I do wonder if there's still just a faith that things will work out. The Fed will maintain its independence, and that's why there hasn't been a market reaction. I don't know if it's because there are so many other tailwinds supporting the U.S. economy. People haven't focused on this. You know, I can never explain markets, but sometimes markets seem to focus on one thing or another thing, and this just hasn't been on the radar because they've been focused on other things. If the threat became more real, maybe it would get more focus. But also, one thing that has surprised me is it wasn't that long ago, the biggest issue in the US was inflation. That was all anyone talked about. That was the biggest concern. And then you didn't worry about Fed independence because the Fed was the bulwark against inflation that was going to bring inflation back to 2%, and that was how you got price stability. But now a lot of those concerns seem to have faded. EU's concern about prices are high, people complain about that. But when you talk to Fed officials, they claim that what they are hearing is more concern about the labor market, not about inflation. And there seems to be a sort of just lack of concern about inflation. If inflation picks up again, we might see a shift back to more attention to why independence is important, and maybe that could actually bring back some more political support as we remember what we've learned through decades of history and learned from many other countries, why it is so important to have an independent central bank. But those concerns seem to have faded recently, and I'm not sure why our memories are so short.
Hélène, and then maybe
on the independence thing. So the way I actually interpreted part of the April 2nd reaction of markets was precisely because people were waking up to the possibility that the institutional setup underlying the strength of the dollar, not in terms of exchange rate, but in terms of a currency, was actually being possibly undermined. And it is very, very impressive when you compare the reaction in the 30 days of the markets around the COVID shock, the announcement of COVID, and the announcement, the April 2nd announcement. You see that approximately all the co-movements between the dollar and the flows into fixed income markets, and not with one country, not with Europe only, but with every market, essentially, except maybe Turkey, because at the time Turkey was in crisis. But all the markets go the other way. The COVID shock, you have a classic safe haven response with the flows into fixed income in the US, out of fixed income elsewhere, the appreciation of the dollar, the decrease in the 10-year yield, et cetera, et cetera. And the April 2nd, you see systematically the opposite. And the way I really interpreted it was this is, the start of a kind of distrust somehow, which is to a large extent linked to what may happen to the Fed. This was a kind of signal from that respect. And so I think you did see increased hedging of a lot of dollar investors, a lot of people who were very long dollars starting to hedging a lot more their exposure, and hence the depreciation of the dollar after that. And the focus was there, so there has been a recalibration of the exposure. Now that there is no more recalibration, I think we might see more, according to the news. And this is a little bit maybe the way the market proceeds, by some events in which people recalibrate, and then there's a period of latency, and then there might be some more, depending on the news coming up.
Sethaput.
Yeah, Ricardo's question, I'm going to answer half of your question. You asked about composition and adequacy, and by policy we don't comment on the composition, so let me address the point about adequacy. I mean, one thing that I think we learned in Thailand, both during my tenure and before, was the importance of being able to self-insure. And I think there's a lesson that came out of the 1997 Asian crisis, and it kind of was one of these traumatic events that shaped, I think, a lot of the policymakers thinking on this. So I think having that high, relatively high level of reserves, has helped us in many ways. One thing that we've been, I think, strong advocates of, per the IMF, is using an integrated policy framework. So trying to use multiple instruments, not just monetary policy, but using FXI and whatnot when appropriate. And having an adequate level of reserves helps us to do that. And I think doing that, being able to have done that, helped us a lot in terms of managing the usual policy trade-offs that we would otherwise face. And we've seen that compared to other countries which have lower levels of reserves, and when they do that, it becomes an issue, and it raises all sorts of sensitivities. So there were many episodes where I was quite happy that we had that high and adequate level of reserves. And I think in terms of resilience, that is likely to continue. Why? Again, there's this concerns on I mean, there have been regional financial arrangements that have been set up, like in the Chiang Mai Initiative and whatnot, but they haven't been tapped. And I think there's a whole bunch of reasons why that's likely the case. But so the fact that those channels are not readily used, again, means that you should rely on yourself to the extent possible and whatnot. Just if I may, on the central bank independence point, because
you're a free man.
It's not just about the Fed, because the thing that happens also is when things happen with the Fed, then people will go say, even the Fed does this, and then they say, why don't you do this? So there's this kind of negative demonstration effect, which could occur. So if things were to be undermined here, it would have implications for the rest of us as well.
That point is very relevant. We see it also in all kinds of dimensions, whether it's industrial policy or other things. I mean, there's a leadership role that is very important here.
Yeah, because I think what Sethaput in his opening remarks phrased it more generally. So how this plays out in different countries will be different. But the basic idea that essentially in a world where there is low growth, where there is fiscal constraints, that basically there's pressure on central banks. So how that pressure is articulated will take different forms. But basically, I think from the central banking point of view, let me say one thing that's important for a central bank is to explain our toolbox. When do we use our different tools? Primarily interest rates, but we do have balance sheet policies. But those balance sheet policies have to be directed at price stability first and foremost. Of course, there can be shocks. Our phrase in ECB is shocks to the transmission of monetary policy. Over here, it's called market stabilization. So, of course, you can have important episodes where the central bank needs to expand the balance sheet. But none of that is fiscal dominance. Whereas to many, political commentators, it's essentially, at the very least, it's confusion. Say, okay, you've used balance sheet policies. Why don't you use them again? Why are you shrinking your balance sheet? And I think we have to be able to explain, which we try and do. And we had a strategy review this summer, which went over again, okay, here's the circumstances where we would use balance sheet policies, but it's very much in reserve. It's in the back pocket. It is not there to basically promote fiscal dominance. So the ECB was set up in a very rigid way to make sure we don't have fiscal dominance. But that's something more or less that has to be continually reasserted because it's self-defeating. It's self-defeating to get the central bank to basically step in and fund on an open-ended basis public debt because it's, as you said, it's not in our collective interest.
We are already out of time, but I'm going to make an executive decision to take 2 more questions. So Steve and then gentleman here, and then keep your questions brief, and we'll have short answers, and then we'll wrap it up, please.
Thanks very much. Fantastic panel discussion. We mainly focus on policy uncertainties, but I wondered if alongside those, there's also a big structural change in the world economy, potentially the rise of generative AI. And that's obviously behind part of the resilience of the US economy is the sort of Magnificent Seven and tremendous amount of investment that's occurring in that sector. And so I was curious for the panelists' thoughts. One, does that itself create another strategic vulnerability if that bubble bursts, if it is in fact a bubble and the real returns are not justified? But then also more generally, the large-scale structural changes that are going to come with generative AI are going to be a big shock to labor markets in advanced countries. And also in terms of the Draghi report and European vitality, the extent to which those industries are concentrated in the US versus Europe is also relevant. So I know it's meant to be a short question, but I'd just be kind of curious the panelists'
What do you think about AI?
on how that sort of structural change layers on top of the institutional uncertainty. Thank you.
We're about to start a second panel just for you, Steve. Please.
Thanks for this discussion. I have one quick question. There's this special preference of the markets for the US dollar denominated safe assets, basically. So if there's if there are risky periods, then money flows into the US, basically. So do you think that this special position weakened in the recent years? Because there was also this large surge in gold, for example, so investors are now looking for alternatives?
Thank you. So I must say that, just as an indirect way to answer Steve's question on AI, I mean, yes, the panelists had marching orders, which didn't mention AI, but they were free to explore whichever topic they felt were most relevant. It's actually interesting that none of them really brought it up as one of the major things. So maybe this is hyped after all, but I don't know. Anyone wants to come in on the last 2 questions?
So I'll take the first one. So the AI, although I didn't talk about it explicitly, when I talked about the rise in US equity markets and then the risks if that rise does not continue or falters, that was partly getting it at AI. Not all. My take is these things often there is a as much as is being priced in. I'm not sure. Will every company whose price is skyrocketing go up? Probably not. So what will be the effects when some of those prices come down to earth? We hope it will just be contained, like when the tech bubble burst. We hope it won't be bigger, but we don't know, and it depends how long it runs. Will it have implications for labor markets around the world? Again, we have to see how this technology is adapted. I think there will be implications. I am not in the doom and gloom camp, though, that we're going to suddenly have excess unemployment around the world. There's been some really nice work out of MIT recently showing that AI can help people do their work very well and very quickly if you want a sort of mediocre job. They call it work slog. You can produce a lot of reports really quickly that's, okay. But if you want really good work, AI isn't there. Maybe it's not there yet, but I think it's going to take some time before we see some big shifts. And then if we get the rest of macro right, if we have flexible labor markets, we can make it easy for people to switch jobs, support innovation. We should be able to create other jobs as some people can do their jobs more efficiently. So I'm not in the doom and gloom camp, but I think we have learned some lessons, the last point, with the China shock, where when you get sudden changes in production and patterns of production and how things are made and where they're made, the transition is not easy. The transition can be incredibly painful. And AI could be another shock like that, where you're going to have sudden shifts in some industries. And I think we should really think deeply about what are the lessons from the China shock when these transitions happen quickly to help smooth the adjustment process.
Okay. Phil, and...
Thanks, Steve, for that question. I think from a European perspective, there's a few, I think diffusion of AI, so saying, okay, even if the a lot of the first wave of innovation has been led by American firms. We are seeing diffusion. So actually, we called that out last week in our monetary policy conclusions. We did a survey of large European corporates and now they're saying, one of the drivers of investment is indeed trying to find out ways to incorporate AI. From a European perspective, with a shrinking, pretty big trend of a shrinking workforce, some of the concerns about labour market displacement still there for youth unemployment and so on. But in terms of saying over the next 20 years, how is Europe going to deal with a rapidly aging population? We might look to these new technologies, including AI, as a positive factor. I think we should be mindful of all dimensions of it. But at the core, there is this kind of positive, I think, assessment.
All right, I think we have to bring it to a close. Please join me in thanking our panelists. I think it was a wonderful exchange. And Philip was right. We didn't really conclude on how to adapt, but we made some progress.